Right now, your relatives can't access a single dollar in your bank account if you pass tonight, not tomorrow, not next week. A will might not help them. A notary might not help them. An attorney-prepared estate plan might not help them. There is one free form, one that can bypass all of it. And the reason many people have never been told it exists is simple. Nobody whose work depends on the current process has any incentive to tell you. My name is Lana Maines. I represent taxpayers directly before the Internal Revenue Service. I sit across the table from the IRS and from bank compliance officers for everyday people. If this kind of information is valuable to you, hit subscribe, because every week I explain the financial and legal facts that protect your money and your family, and I make sure you actually understand them. The single most avoidable financial disaster I see is not a bad investment. It is not a tax mistake. It is a family standing at a bank counter the week after a death being told they cannot access a cent of money that may be legally theirs because one form was never filed. That form takes 10 minutes. It costs nothing. It requires no attorney, and you may never be told about it unless someone like me tells you. The legal structure that still controls your money. The Uniform Probate Code, finalized in 1969 by the National Conference of Commissioners on Uniform State Laws, established something that many Americans have never been told. It classified financial accounts held at banks and credit unions as contractual instruments sitting on a completely separate legal track from your will. States adopted this framework over the following decades, and every state in the country now operates under some version of it. Courts have reinforced it in case after case ever since. What that means in plain terms is this: the contract between you and your bank, not your will, not your trust, not your estate plan, generally governs what happens to your money when you die. A signed beneficiary designation on a bank form can override a notarized, witnessed, attorney-drafted will in many cases. The will controls your furniture, your car, your jewelry, the physical property in your home. The bank contract controls your cash. If you die without a named beneficiary on your bank account, the account does not transfer directly to your heirs. It transfers to your estate, and the moment it transfers to your estate, probate may be triggered automatically. Probate is the court-supervised process of validating your will and distributing your assets under judicial oversight. Many states set probate thresholds between $50,000 and $100,000. If your account balance exceeds that threshold, and for many retirees it does, your family waits. The court moves on the court schedule, not yours and not theirs. Here is what people often misunderstand about probate. It is not always a fast administrative process. In many states, there is a mandatory creditor waiting period of 3 to 6 months built into the law. Unknown creditors, medical providers, credit card companies, anyone who might have a claim against the estate must be given time to come forward before any distribution can occur. Your family may not receive a dollar until that window closes, regardless of how clean your finances were. And during that entire period, your bills keep running. The funeral does not wait. Grief does not come with a financial timeout. That leads directly into Dorothy's story. Asterisk, she did everything right. It still did not matter. Dorothy was 71 years old. She was a retired school teacher from Illinois who had sold the family home and walked into her local bank with $350,000 from the proceeds. She opened a standard savings account, hired an estate attorney for $800, and had a comprehensive will drafted, witnessed, notarized, and clearly naming her 2 adult children, Michael and Sarah, as equal beneficiaries. She put the will in a lockbox under her bed and called Michael to tell him everything was handled. It was not. Dorothy suffered a stroke and died. Michael and Sarah flew in, received a $11,500 funeral invoice, and Michael took the death certificate and notarized will to the bank. The branch manager looked at the account screen, looked at the will, and slid the documents back. Dorothy had never filed a payable on death beneficiary designation. The account held only her name. Because the balance exceeded the state's small estate threshold, the bank had no legal authority to release a single dollar. A will is a letter of instruction addressed to a probate judge. It carries no direct weight at a bank counter. The bank's obligation runs to the contract on file, and the contract on file named no beneficiary. The account was frozen. Michael and Sarah walked out of the bank with nothing. They put the $11,500 funeral bill on their own credit cards, paying interest rates that were running well above 20% at the time, rates common with consumer credit cards, while $350,000 of their mother's money sat 20 feet away behind a counter they could not legally cross. Then the probate process began. The court filing fee to open the estate was $389. A secondary publication filing required by Illinois law to notify unknown creditors through a local newspaper for 3 consecutive weeks cost $250. The executor bond premium cost $1,000. These were just the entry fees. The probate attorney charged a percentage of the gross estate, which is standard practice in many states. On an estate of this size, that came to over $10,500. The mandatory creditor waiting period held the case open for months. From start to finish, the family waited 14 months to access their mother's money. They lost over $12,000 in documented fees, and the interest accumulating on the credit card they used for the funeral kept running the entire time. Dorothy did nothing wrong. She had the will, the notary, the attorney. None of it reached inside a bank contract. Her situation was not a legal error. It was not unusual. It was the entirely predictable result of a system working exactly as it was designed to work. And it has 3 specific entry points where families fall into it. Before I walk you through those 3 failure points, open your online banking right now or pull out your most recent bank statement. Look for a beneficiary field. If you cannot find one or if it is blank, that is already your answer. Write down what you see, because what you find determines exactly which of these traps you are sitting in. 3 ways people accidentally lock their own money. The first failure point is no beneficiary designation on file at all. This is the most common situation I encounter. You opened the account years or decades ago. Nobody at the bank asked you to name a beneficiary. You signed the signature card and left. You assumed your will would handle it. It will not. Under the contractual framework now codified in state law across the country, a will generally has no authority over a bank account. The account defaults to the estate. Probate opens automatically. For a lower-income retiree, this is often catastrophic. A 6-month probate process on a $60,000 account can consume a meaningful slice of that balance in filing fees, attorney fees, and publication costs before a single dollar reaches the family. For the comfortable middle-class retiree, the assumption is usually that the estate attorney already handled it. Most estate attorneys draft wills. They do not file bank beneficiary forms. Those are 2 completely separate documents at 2 completely separate institutions, and almost no one explains that to you when you write the check for the estate plan. The second failure point is an outdated beneficiary designation. This one is more dangerous than no designation at all because it gives you a false sense of security. You named someone 20 years ago, an ex-spouse, a parent who has since died, a sibling you no longer have a relationship with. That name is still on the form. That is who the bank sends the money to. The will says something entirely different. It does not matter. The uniform probate code in every state that has adopted it are clear. The designation on file at the bank controls. Period. Courts have consistently ruled against surviving spouses, adult children, and estate executors who believed a current will would override an old bank designation. It will not. The bank looks at the form on file, not the document in your lockbox. The third failure point is the joint ownership assumption. Many married couples believe that because they are married, all accounts automatically transfer to the surviving spouse. In a number of states, that is simply not true. Joint tenancy with right of survivorship is a specific legal arrangement that must be explicitly created and documented at the bank. Marriage alone does not establish it. The account structure, the title on the account, and the state's specific treatment of marital property all determine what happens, not the marriage certificate. and there is a trap hidden inside the most common attempt to fix this. Many seniors add an adult child directly to their account as a joint owner, thinking it gives their child easy access to pay bills if something goes wrong. The intention is good. The legal consequence is serious. The moment you add another person to your account as a joint owner, the law in most states treats that money as partly theirs. Right now, while you are still alive. If your child is in a car accident and faces a lawsuit, the plaintiff can pursue your bank account. If your child goes through a divorce, their spouse can claim a portion of your savings in the settlement. If your child has a tax debt, the IRS can levy your account to satisfy it. Joint ownership can transfer your exposure to every liability your child carries immediately and completely. The POD designation avoids all of this. It grants your beneficiary zero ownership rights while you are alive. Your money stays entirely yours, generally protected from their creditors until the moment you pass. Then the transfer happens cleanly on contract with no court involved. All three of these failures have the same fix. One form, free available at your bank right now. So here's what I want you to do. The exemptions, the breaks, the refunds, many seniors already qualify for, but never claim. I've put them all in one place, state by state, form by form, so you don't waste hours digging through government sites. Everything's laid out fast and simple, so any senior can find exactly what applies to them. No matter what state you're in, there may be money you're leaving on the table. It's called the Senior Exemption Playbook. It's in the first pinned comment right below this video. Just tap it once and you'll have everything you need. Now stay right here because the last section covers the one form that can make all of this go away, and it's the reason I made this whole video. The form that makes probate irrelevant. The form is called a Payable on Death Designation or POD. The concept traces to a New York court decision called Matter of Totten in 1904, which established that money could transfer directly to another person upon death without a formal trust or court involvement. That principle was codified in the Uniform Probate Code Section 6-101 and adopted in some form across many U.S. states. It is not a will. It is not a trust. It is a contractual instruction to your bank operating on the exact same contractual track that froze Dorothy's accounts. Because it operates on that track, it bypasses probate entirely. The bank never looks at the probate court. It looks at the designation on file. When a valid POD is recorded, your beneficiary presents a certified death certificate at the bank. The designation is verified. The transfer is processed. No judge, no attorney, no filing fees, no mandatory waiting period. Processing time varies by institution. Smaller banks may handle it the same day or next business day. Larger institutions typically take 3 to 5 business days. What it does not take is 14 months. The cost of filing a POD designation is zero. Most FDIC-insured banks in the country offer it. Most federally insured credit unions offer an equivalent. There is no fee to file it. There is no annual fee to maintain it. It costs nothing because it generates nothing for the bank. It serves only you and the people you name on it. What the POD form does not cover and what to file instead. Here is where most people stop and where most people leave gaps. The POD designation covers your individual bank accounts, checking, savings, money market. It does not automatically extend to every financial instrument you hold, even at the same institution. Certificates of deposit require a separate designation. A CD sitting at the same branch where you filed your POD for your checking account is not covered by that form. Each account is its own contract. Each contract requires its own beneficiary designation. If you hold 3 CDs at the same bank, each one needs its own POD filed separately. Brokerage accounts use a different form entirely called a Transfer on Death Designation, or TOD. It operates on the same legal principle as a POD, direct contractual transfer outside of probate, but it is filed with your brokerage firm, not your bank. If you hold stocks, bonds, or mutual funds in a brokerage account with no TOD on file, those assets go through probate, just like an undesignated bank account. Retirement accounts, IRA, 401ks, 403bs already operate on a transfer on death principle by design under federal law, but many people filled out their beneficiary designation when they first opened the account decades ago and have never revisited it. An outdated name on a retirement account carries the same consequence as no name and sometimes worse. Under federal law, a named beneficiary designation on a retirement account generally controls over any conflicting will or divorce decree. If your former spouse is still listed on an IRA you opened in 1995, they may legally collect the entire balance regardless of what your will says, regardless of your divorce agreement, and regardless of how many years have passed. Review those designations today. There is one more asset worth addressing: the safe deposit box. Many seniors store their will, deeds, and valuables inside one and hand the spare key to a family member. That key grants nothing after your death. Bank procedures may require banks to restrict safe deposit boxes upon notification of a customer's death, and your family may be denied entry even with the key in hand. Worse, if the physical will is inside the box, they face a circular problem. They need the will to open the probate case, but they need a probate order to open the box. The fix may cost nothing. Add your child as a joint renter on the safe deposit box contract at the branch. Both of you sign together, and they retain access regardless of what happens to you. What to do before you close this video. Step 1. Go to your bank this week in person or through your online portal and request the Payable on Death Beneficiary Designation form. Most FDIC-insured banks can provide it. If the teller does not know what it is, ask for the branch manager. Step 2. Name a primary beneficiary using their full legal name, date of birth, and social security number. Do not write nicknames or vague terms like "my children." The social security number is how the bank verifies identity at the time of transfer. Without it, the payout can be delayed. Step 3. Name a contingent beneficiary as a backup. If your primary dies before you and no contingent is named, the account defaults to the estate and probate opens again. Step 4. Submit the form in person and request written confirmation that the designation has been recorded. Keep that confirmation with your important documents. Step 5. Check every account separately. Your checking, savings, and each CD all require their own designation. One form does not cover all of them. Step 6. Contact your brokerage and file a transfer on death designation for any non-retirement investment accounts. Step 7. Review your retirement account beneficiary designations and update any outdated names immediately through your plan administrator. Step 8. Revisit all designations every 3 years or after any major life event: a death, a marriage, a divorce, a new grandchild. Tonight, your family still may not touch a single dollar in your account. That could be true tonight. Unless you file this form, the probate system is not broken. It is working exactly as it was designed to work under the framework adopted from the Uniform Probate Code. The POD designation is the one mechanism that operates on the same contractual track and wins. Go to your bank this week, ask for the POD form. It costs nothing. It takes 10 minutes. And if you found this useful, subscribe.